Welcome. Today we'll be going over 5 stocks which are trading near 52-week lows in January 2025. Starting off with Nike, the leading sportswear brand in the whole world, which was down around 18% in 2024 and even more when we consider its all-time highs. Now, this isn't only a price drop because of worsened guidance, it's actually a price drop which is following their fundamentals. These have deteriorated over the past, with their revenues and profits actually becoming stagnant. This is why, despite this decline in price, we can see that their valuation ratios, their price to earnings, their price to cash flow ratios have actually remained quite stable. They're currently trading at a PE ratio of around 23 times, which is not bad, but we have to remember that this company has grown at around a 2 or 3% for the past years. However, when we look at their dividend, they are paying a very juicy 1.9% dividend yield, which is a fast grower as it has a 3-year dividend CAGR of 11%. Now, this is what I was saying. We can see their revenues and their profits have been stable for the past 4 quarters, and this is true for the past 12 quarters because in 2022, 2023, and 2024, they've had practically the same yearly revenue. One thing to note here is that their margins have been pretty stable, which is something very good to see. When we look at its cash flow evolution, despite Q3 and Q4 of 2023 looking extremely well, Q1 of 2024 was not a great cash flow generating quarter, and TradingView doesn't have the information for Q2 2024 yet. However, when we look at their leverage evolution, we can see that their total assets and total liabilities have not moved much, which is great to see since the total assets are way above their liabilities. Number 2 is Adobe, which is in the technology industry. We can see that this stock has been pretty stagnant for the whole year, down a mere 4% in 2024, with a recent rebound in December. Now, here when we look at their valuation ratios, these have actually bounced up and down a lot more than Nike's ones. As at the start of 2024, this company was trading at around 55 PE, and now it's currently trading just at around 40 times its earnings. We have to note that this company does not pay dividends. However, when we look at their financials, we can see that their revenue has been growing quite nicely and that their margins have increased a lot when comparing it to the first quarter of 2024. Currently, their net margin stands at 30%, which is impressive, and it's great to see for a technology industry, which in theory is being challenged by AI. However, we can still see that its revenue is growing quite nicely, that it's increasing its margins, and that this is still a free cash flow generation machine, as we can see by their Q1, Q2, and Q3 free cash flow all being very stable and very, very close to its net income. Another thing that is great to see from Adobe is their leverage evolution. Every single quarter, they have had double the assets than their total liabilities, implying that this company will not have to worry about liabilities anytime soon. Now, number 3 on the list is Uber Technologies. It's weird to see this company here because they have had an incredible year, so many advancements, their margin expansion, they've become a lot more profitable than in the past years, and we can see that throughout the year, this company was up around 70% when you compared with the year-to-date window. However, in the past months, this company has gotten a hit after a hit after a hit, and it's now only around 2% down for the whole of 2024. There are many rumors implying that this is because they're getting a lot more competition from companies such as Waymo or Tesla, and Uber is getting left behind. However, I don't agree that this is the only reason, and even if those two companies starting to get into this space, I don't think that would cause such a huge dent into Uber's revenues as this is forecasting. Now we can see the valuation ratios that it even got to the point where it was trading at around 120 price to earnings ratio. However, now it's normalized, and for such a high quality growth stock, it's trading at 35 PE ratio, which in my opinion is worth considering, and I'll be doing a further deep dive on Uber in order to see if I should buy this stock or if I just should stay on the sidelines. Now, of course, since this is such a high growth stock, they decide to invest everything into their business, and hence they're not paying any dividends. And this is what I was talking about. Just look at this revenue growth. It looks fantastic, but the beautiful part about this is the net income that they've shown that they can actually provide to investors. Just look at that margin evolution. It went from negative in Q1 2024 to a 23% in Q3 2024. And the most beautiful part about this stock, well, apart from its growth, is its free cash flow evolution. It's as predictable as they come, It's growing every single quarter, and you can always count on Uber to actually provide this cash flow, because in Q1 2024, a period when their net income was actually negative, they still managed to return over $1.2 billion in free cash flow to investors. Now, on the other hand, when looking at their balance sheet, their total assets have actually increased in Q3 2024. However, they're still maintaining a very good current ratio, as their total assets are way above their total liabilities. I believe that Uber is worth a deeper dive at the current moment. Now, stock number 4 is Vertex Pharmaceuticals, ticker symbol VRTX, and it's of course in the pharmaceutical industry. This company had a very good 2024 until the second half of the year, when its price actually started to decline. It has ended the year down 13%. And when we look at its valuation ratios, we can see that it was trading at around a 25 PE ratio, and in Q2 2024, they actually came in at negative earnings, which is why we don't have the valuation. Now, this company does not pay any dividends, but we can see that it's had a very weird year. Now, its revenue has not moved much. It stayed pretty consistent, growing little by little, quarter by quarter. But in Q2 2024, they had a loss of close to $4 billion, which made its net margin decrease exponentially, and also its free cash flow go into the negative territory by a lot. Now, if we eliminate this quarter, it actually looks like a pretty solid stock, as we can see that its free cash flow has been pretty stable and that its balance sheet is looking amazing, as they have around 3 times the amount of total assets than total liabilities. However, before moving on to buy this stock, I would like to analyze why net income was so negative in Q2 2024, because if it happened once, it can happen again and again and again. And now, last but not least, we have the famous Hershey Company, which has not had a great year in 2024. You can see that it's down around 4% for the full year of 2024, and that its price to earnings ratio has not moved much. It's been trading around the whole year between the 16 and 24 price to earnings ratio, which is not a bad spot, considering that it pays a very juicy dividend of a 3.21% dividend yield, which has been growing at a 3-year 12% CAGR. And when we look at the revenue and income evolution, of course, this is a very cyclical stock, but we can see that overall it's maintaining its revenue and its profits that it used to get. However, in Q1 2024, it did have a way higher net margin than the ones they're having now. And this could possibly mean that the cocoa or higher supplier prices are actually starting to affect the company as a whole. However, the thing that I love the most about this company is how efficient it is at generating free cash flows. They may not be growing consistently, but they are very, very stable. The one thing that I would improve about this is for them to become more predictable. But now, when we look at its balance sheet, we can see that it's also having a very safe current ratio, as its total assets are above its total liabilities. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. And having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.